right? Look, join me. Link in bio. Let's get into it. So people think that it's just a matter of getting in. You're going to make millions of dollars, hundreds of thousands of dollars, or in a better sense, thousands of percentage gains on whatever they put into the market. And of course, that happens all the time. But what happens more often is people getting wrecked all the time. And I'm not talking about leverage trading or anything like that. I'm just talking about accumulating anything and being late or being bold or not understanding technical analysis, not understanding fundamental analysis, buying off of hype, seeing it in the news, hearing somebody talk about it at a party, looking at someone's shirt in the Starbucks line, feeling like you're left out. You're not missing out on anything. Everything moves in cycles. It's a matter of where you are in relation to the cycle. And what cycle are we referring to? There are so many cycles, right? Some people follow the moon cycles, moon phases. Some people follow a real estate cycle. Some people follow the Bitcoin cycle. Look, the federal funds rate is the most important cycle of any type of cycle if we're going to look at any cycle, right? Because the reality is that tech stocks, cryptos, blockchains, of course, included, at this point are risk on assets. So when the risk is hype and people are willing to borrow money at lower interest rates, then yeah, it's time to get risky. And therefore they'll get into Ethereum and everything below it, XRP and everything below it, Solana and everything below it, and whatever else comes up in the top 5 or so and below those. Because the risk is much lower and there's an appetite for more upside. Now, when interest rates are fairly high, or they're starting out fairly high and they're rising, it's going to be pretty much a Bitcoin only type of environment. And even that is still really risky. And then as interest rates lower, at some point in time, you might see some drops in the market as well. People would be willing to sell now and jump back in the coming months when interest rates are lower. So, sell when you're up and anticipate a dip. So if we have any type of disasters, scenarios that can kind of scare people in a sense, and the market makers decide to drop price into the levels that have kind of already been there waiting to be hit at some point in time, couple those drops with lower interest rates, now we're talking about a great investment opportunity, right? Every time there's a crisis, as you know, there's some form of opportunity. Love it or hate it. That's just the reality of this world, right? Especially when we're talking about investing. You want to buy when people are scared, when people are fearful, when the prices are down. And I'm not absolutely encouraging anybody to do anything such as catching falling knives, right? You see the price dropping and you decide to buy. Well, it could keep going lower. But again, either way, you want to buy today and the price is dropping, and you buy tomorrow while the price is dropping, you're still getting it at a lower rate. Again, we're not speaking about leverage trading here. We're just speaking about specifically more accumulation, right? So you have institutions, you have the federal governments and various banks and all sorts of institutions accumulating digital assets. If it's good enough for them to accumulate, I'm just curious to know, why is it not good enough for you and I to accumulate? If they're accumulating it now and you and I are not accumulating it, what does that tell you? Does that tell you that we have fear? Does that tell you that they have an advantage in terms of perhaps cash flow? So that's one of the biggest things. We talk about the martingale strategy. Some people say DCA, dollar cost average. That could lead you to the pits, to be honest. Kind of blindly throwing darts all the time at this dartboard, no matter what, whether the lights are on or off. That may not necessarily be the best strategy. The martingale strategy, however, may be even worse depending on the type of environment you're in. Because if you're buying and you're doubling your buys as the price drops and the price just keeps dropping, well, now you got to make sure that you've got a plan. You've got an entry plan. How many times would you actually jump into this as the price drops? What are your targets, right? It's so important to know your levels, right? Because when you know your levels and you know your targets, you don't have any fear of missing out. Not to mention, couple that with the ability to buy in an uptrend, meaning you want to assess something. And this is more specific to cryptos because they're not so old. They don't have such a long life yet. You might, with Bitcoin, you may want to look at the weekly. With Ethereum, you may want to look at the weekly just to see what the formation's looking like, what type of trend is it. But you may have to go down to the daily. And in a lot of these tokens, you have to go down to the 4 hour and the 1 hour just to get an idea. Has it had 2 or 3 rises? Has it had 2 or 3 drop levels? Do you see an M forming on the daily? Do you see a W forming on the daily, 1 hour, something like that, the 4 hour? You have to look at these levels to determine when it's actually a good time to jump in. And if we're talking about buying, I'm not speaking specifically now about leverage trading. Leverage trading, we can definitely dive in a little bit deeper because that requires, a lot more analysis in a sense, because there's so much more risk on the table. But if we're looking at accumulation, we're looking at accumulation zones. As price drops, you may get happier. But again, how many times can you jump in and double your investments? It just depends on what your targets are. Know your targets. Scroll back on the chart. Look at where there are large wicks to find where there could be trapped traders. Look at large vector candles that have huge volume. Price typically does return to those areas on any time frame, at each and every time frame, right? So we can dive in, again, join me, fill out the form in the description, join, get a one-on-one, and we'll take it to the next level. Because a lot of you guys and girls, you're getting money, from your parents. Maybe you earned it yourselves. That's great. But you're jumping into the market at the wrong time. Now, it's more than just education. It's also mindset. Because if you have a fearful mindset, like you have to get in now, or you're punishing yourself for missing opportunities, or you lost a lot in previous cycles, or whatever, there's so many reasons why people's mindsets are not right. A lot of them come from the idea of feeling late, feeling like you have to catch this opportunity right now. Let price come to you, but of course, first, you must know your targets. That is critical. Plan it out, know your targets. But on top of that, understand that the market maker moves price. It's not just the bulls and the bears. You hear so many people talking about the bulls and the bears. You and I do not have enough money to move markets the way the market maker does. Okay? You'll look at candles that return to the exact point of the candle, the exact peak or the exact base. Do you think you and I made that happen? I'm not really asking you because I know you're all sophisticated people, but still some of you have money that you just got, money you inherited, money that maybe you did some whatever to get your money. Of course, some of you made this money with your brains, your sweat, your blood, took a lot of time, and you want to put in the right place. Those are the people who get affected the most when they lose because they put in so much time and energy to get this money, and they put it into the market based on some clown's advice. Well, first of all, you're taking advice from the wrong people. And second of all, why are you taking advice from anybody? Have you had a one-on-one? Have you had a chat with them to get to know better what their experience is? Or is it a matter of just getting the hype and hearing it in the news? Because as we know, the news media is typically too late or misdirecting. It's not always necessarily false or a lie or wrong or something. It's just more about the timing. Right? And if you hear something that's fearful, brings up about negative energy in the economy, in the society, look at the charts of the major assets, such as the NASDAQ or the S&P or Bitcoin. We use Bitcoin as kind of the North Star, some type of guidance system to let us know how liquidity is flowing into the market. So if you're seeing, for example, Bitcoin kind of stalling out at a high level, let's say, for example, at an all-time high, and it's just not going through there for the past weeks or months, well, there are a lot of over-the-counter deals or OTC deals, which essentially is just a way to sell or buy assets but not affect the price. And this is what I mean, or the supply. Here's what I mean. For example, if you went to a store and they had a huge sale and you bought a lot of this particular product, okay, you bought 20, 30 of them, and you decide to sell some of them to somebody online, not in the retailer, not with receipts and, stock being adjusted. That is not going to change the total supply. That's not going to change the price on the market. You're just selling it over the counter. So with Bitcoin, there are huge sales being done over the counter, just by phone, by email, e-transfer, whatever it may be, bank transfer, wire transfer, you name it. And that doesn't affect the price of Bitcoin. So if people are accumulating Bitcoin, back to this idea, there are institutions, the presidents, the administrations all over the world that are accumulating assets like Bitcoin and Ethereum and Cardano and Kronos. There are just so many, too many to name. Solana, you can name them again and again and again. HBAR, there's so many. They're accumulating them, and in some cases, the price is not moving in any major way, especially something like Bitcoin, right? That's oftentimes because maybe the miners are selling. Sure, that's absolutely a thing. Old-time OG holders have been selling. Sure, that's always a thing. But there's always acquisition liquidity. There are always people that want to buy the asset that other people are selling. So sometimes when those people are buying large amounts, hundreds of millions of dollars and such worth, they are not going on to a centralized exchange or some app that they downloaded and dropping $1 million directly from their phone or from their computer with a few clicks, like $3, $5, $50 million worth. They're not doing that. At least not just at one point in time. They're going to buy over time. Again, back to the point, know your targets, know your levels. They're going to buy incrementally, or they're going to strike a deal directly with a miner, directly with an individual, some type of organization. They're going to invest in ETFs, you name it. And then those ETFs, are they just going to the exchange and just buying Bitcoin? Or are they accumulating Bitcoin directly through deals, directly over-the-counter OTC deals with miners and other institutions? You ask yourself this question, and what would you do if you had $30 million? Are you just going to go spend $5 million worth of it on Bitcoin right now and just go buy it on an exchange? Are you going to do that? The answer is probably not, right? So now we're getting to another level of sophistication and another level of understanding of why the Bitcoin price, for example, Bitcoin, doesn't necessarily skyrocket, even though there's so many inflows from all of these different institutions. Why isn't the price going higher? Too many people are selling. The bears are selling. The bears are selling. The bulls are buying, but the bears are selling. Like, it's real, but it's also not real. It's kind of a show, market makers will create levels on the chart, which then in turn would actually create or suggest a trend. But they don't create a trend necessarily. They're creating levels. We are seeing the trend as a result. It rains a lot. And does that mean that the rain necessarily created this pool?